Welcome or welcome back to another Tech Talk from MarketEdge.com, your source for unbiased technical stock research on over 5,000 stocks and ETFs. My name's Rachel, and with me today is David Blake, CMT, here to discuss last week's market and what we should look for as we head into this week. David, how are you doing today?
I'm doing well, thank you.
Great, let's jump right in.
Okay, well, we had another volatile week last week, mainly back and forth bantering between the U.S. and Iran. But it was an up week. That was the second week in a row for the major averages. And I think for the S&P, we've been up something like 8 out of 9 weeks. So we still keep nudging higher. One of the things we had, despite the short week, was a little bit of a peace deal signed between the U.S. and Iran. That brought oil prices briefly down below $80 to start the week. So we had a pretty nice rally off of that. We had the airlines and cruise lines jumped up on that. That made the consumer discretionary sector the second best performing market group for the week. Technology was still the top sector, and mainly once again because of semiconductors. The Philadelphia Semiconductor Index was up 5.5% on Monday alone. I think finished the week up about 9.5%, something like that. So it just keeps making new highs. Making another new high today is Micron, which led the market last week, is making another new high today as we do this here on Monday, the 22nd. We did have a little bit of a pause on Tuesday last week. The banner kept going back and forth, but we did see more of the cyclical sectors pick up some of the slack. We had the financial industrial sectors outperforming. The Dow hit a new high, led by Goldman Sachs and Visa. And on the industrial side, Caterpillar and 3M led the broader market. So even though we were mixed, that was a nice broadening out a little bit of the rally. The big deal last week was the Federal Reserve meeting with the new Fed Chair, Kevin Warsh, and he didn't surprise anybody with leaving rates unchanged. However, he was a little bit more hawkish than what the market expected. So we did have a knee-jerk reaction to the downside after he gave his comments, but then we started to move back up in the afternoon and actually finished higher. The move in rates was mainly on the short end. It was mainly the 2-year T-bills that were moving. That closed up around 422 on Wednesday, I believe. And that was the highest level since January of 2025. So equities kind of moved lower on that. But then we got confirmation again on Thursday that the peace deal would probably be signed over the weekend. Oil prices came lower again, and then you had yields also dip a little bit again going into the weekend. So all in all, is again just back and forth. Bannering keeps moving equities up higher and lower. And that probably will go on a little bit this week. Now, we did have Iran today said they saw good progress in the talk. So we'll see how the market reacts during the week. So far, we're doing pretty well. We're up across the board. Again, semiconductors are leading the market higher today. As far as the technical condition of the market is concerned, we did have a couple indexes post new record highs last week. The Dow did. I think the small cap Russell 2000 also hit a new high. The NYSE hit a new high. So we're seeing some broadening out of the markets, which is what we wanted to see. Some of the technical indicators, though, we're seeing a little bit of a slowdown in some of these, especially in momentum. And if you look at the 14-day RSI, and I'll bring that up right now. When we talk about this negative momentum, where an index or something will come up and hit a new high. However, the indicators don't confirm that. If you look over here as we're coming up here to make a new high or close to one, you can see over here with this line, we're going in the 14-day RSI from 73 down to about 65. You don't want to see that. You want to see the indicators also make a new high when the averages do. Here's the diamonds, which did make a new high last week. You're also seeing here on this, we made a new high over here and we're maybe 60 or something like that. And down here, we're back down. But anyway, you're not getting a confirmation. You should see this, the 14-day RSI making a new high as the index is making a new high. And we're not seeing that. So that slowdown is something you want to kind of keep an eye on. It's one of the better negative divergence signals that we see on the chart. So keep an eye on that this week, especially if we make new highs again in the Dow Jones. And it looks like we may do that this week again. Okay, other than that, MACD was kind of neutral. We did see a bullish cross on the Dow Jones, which is a positive. We're not overbought at this stage, and we were back up in the stochastics. We're up in the 90s, I think, about a week and a half ago. We were down around the 50 level this past week, which is not overbought at all. And in fact, the MarketEdge S&P short range oscillator, the SRO, that you can find on the homepage, was down. It finished the week at 177. So that's not near where you want to start seeing institutions going out. I saw something this morning that caught my eye on Reuters, and that was that we had a record amount of inflows into U.S. stocks last week. So despite some headwinds, we are seeing earnings going higher, which is again is a tailwind for stocks going forward. So I don't think that you want to be selling these rallies yet. I do think that we'll have some a little bit of limited upside, but I don't think we're seeing the negative divergence where you want to, jump ahead of the market and try to get out before we have some kind of a correction maybe later in the summer. The secondary indexes, which I like to follow, can compare how they're performing versus the major averages. That includes the transportation index, the small cap Russell, and semiconductors. They were mixed, mainly because the transportation index fell a little bit. I had to see what was going on with that. A couple of weeks ago, we were seeing the transportation index taking a big run higher, and it was mainly due to Hertz Avis having some short cover rallies, this kind of thing. It was going up 30% a day, that kind of thing. That was kind of skewing the signals on that. But anyway, we had the Russell 2000 and the Philly Semiconductor Index hitting new highs last week. And that's something that you want to see happening when the market's going to be moving higher. You want to see the secondary indexes outperform. And that's because that means that investors are taking on a little bit more risk as the market's moving higher. So that's a good thing. We did see the index, the semis jump. I guess it was 7.3% last week. But anyway, they're up. That SOX is up 100% since its March low. And that's quite a move, a parabolic move that I don't know how long it can last, but as long as we keep getting upgrades on these, I guess it can move higher. The breadth was only slightly positive last week. As I said, all three majors averages were higher. In fact, the NASDAQ was up 2.4%, but the NYSE advanced decline line was off about 100 units, and the NASDAQ AD line was only up about 100 some units. So that's not everybody jumping in just buying everything. That is pointing to parts of the market that still are just outperforming, and it's a narrower group of stocks than what you want to see if we're going to have a big run higher. So a little bit of caution on that. It's not something that you want to chase. It's just showing you don't want to chase this rally too much higher, especially if they hit semis and that kind of thing. And we also saw a little bit investor sentiment. We saw that more investors moving into the bull camp, especially the active investment managers. We saw exposure to equities jump up to 92.8% from 79.3%. And that was a 3-week high for professionals jumping into stocks. So that's something that they're pretty excited right now. I think that if we've been talking quite a while here, that once we would get this U.S.-Iran deal behind us, then we're probably going to see a pretty good rally in global markets. So that's something that we'll keep an eye on. We'll probably get another push higher with that. As far as the week coming up, tomorrow we have earnings from Carnival before the market opens. Then we get FedEx after the close tomorrow. Wednesday, of course, we have Micron Technology is going to report after the market. That Micron's been moving up into this report. They're probably expected to blow it out. I think they're looking at $20.45 per share earnings with revenue of about $35.5 billion. So if you watch those numbers, if they don't beat them pretty handily, you might see Micron pull back a little bit off of that. Okay, the big news this week, because it's kind of a light week as far as earnings and economic data goes, it's going to be the Federal Reserve's preferred inflation gauge, which will come out on Thursday morning. That's the personal expenditures price index. They're expecting that to rise 0.4% in April. Of course, that's because of the oil, the impact of the Iran war on the energy prices. But we'll see how that goes. I'm not sure what they're looking for the core PCE right now. But other than that, I think we're going to have some whipsaws here off of the talks. So just kind of put out some of those headlines and try to put them out of your mind, and just know that right now, as oil prices come down and yields stabilize and earnings keep being knocked higher a little bit, that we have some pretty good tailwinds behind stocks right now. And I would just hold on to what we got and just see how things roll for a little bit.
Very good. Thank you so much, David. Is there anything else our viewers should be watching out for this week?
It's a pretty quiet week as far as economic data goes. Earnings are pretty much behind us. We have a couple big hitters, with the Micron and FedEx and stuff like that. But I just think that we'll see the market vacillate higher and lower based off of headlines coming out of those talks. And I think it probably would be wise to try to get that out of your mind and just know that the market should be stabilizing in here. But you're going to have some jumps up and down based off of the headlines coming out of there as somebody gets mad at somebody else and the bickering picks up again, unless they break off completely. And then you could see the market take a little ride down, but it's probably unlikely that that's going to happen.
All right. Thanks, David. If you have questions for David or anyone else on the MarketEdge team, feel free to reach out to support@marketedge.com or drop a comment below if you're watching on YouTube. Your first 2 weeks of technical analysis on over 5,000 stocks and ETFs are free at marketedge.com. Thanks so much for watching. Don't forget to like and subscribe, and we'll see you next week.